Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and joining me in the studio is Dale Colclaser. He is the president of Wealth Management and the co-founder, Mark Smalling. We're so glad you're joining us today. The title of today's show is Market Volatility and Your Retirement Date. You're going to want to stay with us for this important conversation and what that might mean for you. But first, Dale, Mark, always good to be here with both of you. How are you this week?
Doing great.
Doing
Good.
fantastic.
Well, and I know you've also been busy with a lot of live events happening throughout the area. Why don't you share with our viewers? I know a lot of folks are excited to come in and meet with you one-on-one, but also would love to get to meet you at some of these live events. So talk about what you have going on and how folks can connect with you there.
Yeah, one of the most exciting things we've had, Kristen, is we've kind of started venturing a little further out of the central Arkansas area. And we've had great success with registration numbers there. There's people that obviously get to see us on television, and then we see them come into a live event. And it's actually been really interesting to hear people's comments and say, hey, I've heard these things you're talking about. I wanted to come see for myself in person.
Right.
I think one of the greatest advantages is it's kind of the consistency of conversation.
Yep.
You know, they hear these things that they're not hearing either their current advisor talk about, or if they don't have one, topics that have never really been discussed. Then they hear us touch on them, on these shows, and then they want to come and see in person, hey, is this really who these guys are? And when they find that out, it makes that conversion rate, and I hate to use these marketing terms, but the idea of those people that show up that then want to then come into the office and set up an appointment. But it's great for those that just want one little extra touch, before they come out.
Yeah, and if you want to see when the events are, they're on our website. If you don't catch the marketing otherwise, but they're always listed on our website.
And list the website for viewers?
It's theretirepath.com.
Yes,
is
theretirepath.com.
Real simple.
Yep, very simple for sure. Well, I know folks always ask me what you guys are like, and I say what you see on TV is what you're going to get in person. So I think that's really fabulous for folks to get to come see you and interact with you at a live event as well.
Yes.
So check out the list of upcoming events in your area at their website, which is theretirepath.com. All right, well, it's time to talk about the subject at hand, which is market volatility and your retirement date. And I just heard you, Dale just sighed over here, but it's because it's a huge, weighty subject, right? I mean, it's very serious. The reality is managing your risk becomes more important than ever, especially as you are approaching and entering retirement. We refer to this season of life as the retirement red zone, that critical 5 to 10 year window before you retire and after you retire. We're going to explain why that is, why you can't afford to lose during this critical time period. And so we have to be prepared for it. This conversation was really inspired by a recent conversation that you had with someone who came into the office who wanted to meet with you, who had a specific retirement date in mind. And I'm confident that a lot of our viewers watching are going to be able to relate to that story. So would you mind sharing that with us?
Sure, Kristen, I would. We had someone come in the last couple of months, and we work a lot with employer groups in Arkansas, and one of them has their own stock that a lot of their employees are heavily invested in. And so we had this couple come in, and we were going through all this. They thought they were in great shape, that we've had a market downturn, so the dollar amounts they were seeing in their account have dropped 25%, and that's a concern since they're looking at about a 3-year out retirement date. And so he's very concerned about whether or not he's going to be able to still retire 3 years out like we were planning to. Also in the middle of all of this, and from when we first met them, his wife actually is going to be losing her job earlier than expected.
Wow. Yeah.
So life happens.
Yes.
And when life happens and we don't have a plan in place yet. We're working on it, but it's difficult to know what to do in that situation. Oftentimes, he was very emotional the last time he was in the office, which is understandable. I mean, it's easy to say something's gone down 20%. It's hard to see something go down $200,000.
Yes, when you put a monetary amount to it, in all seriousness, that really changes the depth of feeling and the impact that can have.
Right.
And I think this is the problem, right? We know that the market only does one of two things. It goes up, it goes down. No one has a crystal ball. No one knows when that's going to happen. You can't control what the market may or may not be doing right at that critical time when you're trying to retire. And to see a hit like that, when you have been saving this money throughout your career and working so hard to accumulate it, and then knowing that now you're going to be left with less to withdraw from for the rest of your life, this is why this is such an important conversation.
Well, yeah, I mean, because the reality is the market pundits, as we like to call them, always talking percentage points.
Right.
You know, and 10% is always 10%. But 10% of 100,000 20 years ago, when you're starting to accumulation in your accounts, is 10 grand. You know, 20% of $1 million, or heaven forbid, 2 million, if you've been really successful, is $200,000 to $400,000.
Right.
And when you start thinking in those type of numbers, you know, it just is very unsettling to people.
For sure. Well, I know a lot of folks watching can probably relate to the story of, okay, I need to be prepared. I'm not sure what the market may or may not do when I'm trying to retire. But I think it's important for everyone to get on the same page about the different stages of the retirement planning process. And really, you always talk about that there's 3 stages, right? So why don't we walk folks through what those are? Yeah,
okay. I think that explains the most of it, because I think the huge challenge that comes is that, especially if people have been working with an advisor through the accumulation phase, as we'll call it, and they think they've had this retirement plan in place. Oh, I'm going to have this great little bucket of mutual funds or other investments that's out there. And as long as I keep this allocation appropriate, which I don't know what the heck that means, because most of the time when we have conversations with people and we talk about risk, which is one of the determinants you have to figure out an appropriate investment allocation, a lot of these people think they're more conservative, or they feel they're more conservative than their allocations honestly are, because up until current downturn, we've only seen 2 real downturns in the last 17 years. And to so many people, a conservative allocation means I haven't lost any money. And the reality is you could have had a very aggressive allocation for the last 17 years, and you've only had about 3 negative quarters during that period of time. So there's a lot of people that are much more aggressive than probably they ever intended to be or ever meant to be. But that first phase is accumulation. The reality is I'm just piling money back into these plans. Hopefully I'm doing it on a consistent basis. If I'm very fortunate, my employer is also adding to that for me. And so the idea is volatility occurs and markets fluctuate up and down, that actually benefits your situation. You're going to wind up with more money in your account. So if you're one of those out there today, and this is just quite a tip, then if you're concerned about market volatility, please do not adjust how you're allocating your funds, at least to your contributions, because making contributions as volatility occurs is actually going to benefit you later on. Now, if you want to change your current allocations, or you've already done that with the large portion of money that's in there, completely different conversation possibly. But the reality is adding money while markets fluctuate is beneficial to me. Then once I quit and I retire and that paycheck stops, I'm now going to start what we call the distribution or the deaccumulation phase. I now all of a sudden have converted this pot of money I've built now into an income stream. It has to continue to kick off money to me on a monthly basis, and regardless of what market conditions are. Because Kristen, I'm here to tell you, the mortgage company doesn't care that the market just stepped off 25% this month. They're not going to wait 3 months for the market to recover for you to make that mortgage payment. If your plan is, I've got to sell assets, folks, you got to sell assets. And we have to see those declines or the securing of those losses in those positions. While both of those 2 options are going on, we're kind of in what we call the preservation phase as well. There's that window of 5 years before and 5 years after where we really want to at least see the money that I know we're going to have to spend in the next 1 to 5 years in a spot to where that principle is preserved. It really does not fluctuate. Now, as you'll notice, I didn't say everything, but that money that I need to spend over those next couple of years, well, here's the reality. If you haven't built a written income plan and you don't know how much money you're going to have to spend, you don't know how much money to put in that kind of position. And so very commonly we have people come in and I'm like, how much have you set aside? And they're like, we've never had this conversation before.
Right. Yep.
because the advice for accumulation never phases, never changes into distribution.
Right?
You're right, because it doesn't matter, because
the market
academics
always comes back, right? You hear having that long-term focus is really key.
Right.
I mean, whatever iteration of that, right?
Well, and here's the reality. Great if the market comes back.
Right.
But here's the difference. Dollar cost averaging is now working against me. So if it helped me during accumulation, I'm not going to sit here and spew statistics at you because everybody's different. But the reality is, if dollar cost negative is going to hurt you. And that's what I know for a fact. And the reality is, if I have certain dollars that are allocated into a position that do not lose money, I repeat, do not lose value so that the income stays the same, I'm giving myself more options and more choices of how to get through these difficult times.
How often would you say when folks do come and meet with you for the first time that they're even aware of how the money they have accumulated is even being invested?
They don't really have any clue about how it's being invested. And most of the time, especially if it's employer plans, they're in target date funds, they're set up, they think it's being managed for them. It's being managed to someone that's in the same position they are, the same age.
Right, it's a very cookie cutter
It's very
approach.
cookie cutter.
Yeah.
And so, if, I would say that if you're in that situation, you don't know how things are actually being managed in your portfolio. You don't know what a written income plan looks like because you probably don't have a written income plan, and you're in this red zone, or even before the red zone would be even better. But if you're in that 5 years before, 5 years after retirement, and you have questions about what to do with all this market volatility around us and all this uncertainty, give us a call, set up a time to come in and see us.
Yes, I think that's one of the big reasons why it can motivate folks to take action, right?
Oh, yeah.
Because when you see these fluctuations, we know it can produce a lot of fear and a lot of insecurity. But here's the good news. Once you have a solid plan in place, you can be confident that you can still accomplish your goals and make it through retirement when you know where your income is coming from and how it can be protected from the market volatility that we're discussing today. So if you would like to reach out and connect to schedule your time to receive your very own complimentary written income plan, 2 ways you can connect. Simply call the number on the bottom of your screen, 866-724-3893, or you're welcome to scan that QR code and that will get you connected as well. Don't go anywhere. When we come back, we're going to dive more deeply into this conversation of market volatility, how you can protect yourself, and we might find out some fun facts that have to do with roller coasters and your retirement plan. Stay with us. We'll be back with more right after this.
Good morning, Ben.
Good morning, Ben. Hey, birthday party for Carolyn 5. Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there or be square. Happy birthday to you. As you can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Arkansas Money Talk. I'm Kristen Oakley here with both Dale Cole-Clazier and Mark Smalling from Retire Path Wealth. We're so glad you're joining us today. We are having a very important conversation all about market volatility, because here's the reality. We know that one of the things that can scare retirees the most is downside market volatility. I mean, most people love the upside, right?
Sure.
When it's up, it's great. But when it's down, especially when you are trying to preserve what you've accumulated for retirement, it can be really detrimental in the absence of having a plan. And we often liken it to riding a roller coaster. And so before we get into some more strategies of how to successfully navigate this retirement red zone, I just have to know, Are you guys fans of roller coasters?
Oh yeah,
Yeah.
amusement park.
Okay,
I
at an
am.
amusement
An
park,
amusement
right?
park, yeah.
And any favorite ones come to mind? that you
Well, I mean,
love?
I can think the first one I ever rode was when I was 5. It was the Cannonball at Opryland.
Oh, fun.
Yeah,
Which
old
doesn't even
wooden.
exist anymore.
It doesn't even exist
showing
anymore.
our
But yeah.
And how about for you, Dale?
We had a unique experience one time where we were with a group that had rented out Universal, and so we got to ride rock and roller coaster like over and over and over and over again without getting it off. So that was a pretty neat experience.
Yeah.
Oh, yeah. No, roller coasters are a lot of fun when you're younger, but I have heard from a lot of people that the older you get, maybe you don't want to take the one that's as high or as scary, right? The same is true with our money. I think this is why it's a really powerful analogy for what we're talking about today. And, you know, right now at the time of this recording, early 2025, this has been one of the worst starts to the stock market that we've seen over the last several years. And, you know, I think a lot of folks are probably coming in and concerned. I mean, are you hearing these concerns? What are folks saying to you?
Oh, we absolutely are. I mean, it's, you know, especially if people are very close, or they're in that red zone, that 5-year period before retirement.
Right.
There's definitely a lot of concern about, you know, when you're seeing your accounts shrinking in a dramatic way, and most of them are tied up in qualified plans at work. That's where we see 90+% of the dollars for most people that come in to see us.
Right. Yep. And so, you know, navigating that and knowing, okay, this is what I've saved up. This is what I'm counting on to last me the rest of my life. It can be really detrimental, as we said earlier in the show, to see it take that huge dip. I know a lot of folks, when they see the market doing crazy things, they are very tempted to move to cash. That's a question that I used to get when I traveled nationwide. Okay, the market's doing something crazy. Should I pull it out and take it to cash? What do you say to folks who are considering that?
Well, the honest answer to that one is Kristen, and I'll follow up with the last question. You said you get a lot of these calls. We're getting a lot of this concern from people we haven't met with.
Yes.
But here's the honest answer. We're 2 weeks into this deal, and we've had 2 client phone calls. And both of them were, hey, do we really just kind of have to ride this one out now? And the answer is, you know, we're in a couple of different spots.
Right.
Because one of our primary objectives is to always have cash in a position. And so, again, I'm going to go back and reiterate this again. So many times as we're through the accumulation phase, our assumption is we keep cash for emergencies. When we get to retirement phase, guys, we want to build cash for emergencies as well as opportunities. A unique thing happens with these market downturns is there's a huge, massive opportunity on the other side, you know, because we're going to be able to buy good quality companies at much lower prices, again, of stuff that we thought we had missed. You know, but the reality is that we've got to have a plan in place for that to occur as well.
Right. Yes. And so again, this is why no two situations are alike.
Right.
But I think what a lot of folks don't understand is if you are, like, let's say the market has gone down, right? As long as you don't sell, you haven't locked in that loss.
Well, and that's the beauty. If you have investments that are generating income, I don't have to sell that investment to get the income to pay my bills.
Right.
That's a huge issue, I believe, for a whole lot of folks coming in. A number of people that we've met with over the last year that have chosen, after meeting us, to still go on my own path is because we didn't give them a rosy enough future picture for their performance. And here's the honest reality. A lot of these people have been buying NVIDIA, okay? I'm not picking on NVIDIA, but the reality is it's made a whole lot of people a whole lot of money in the last couple of years. It's had a massive pullback, which, you know, again, I'm a believer that it's going to recover as well someday. But the fact of the matter is, if that's the greatest part of your portfolio or other growth style stocks that don't generate income, the only way you get your $5,000 this month to pay the mortgage is you got to sell $5,000 worth of NVIDIA. It can't grow for you again next year. And so that's a huge issue that people do not look at when they make that transition to retirement, is where is this income going to generate? Not only that, if you've had all of these dividends and everything continuing to reinvest every single month and you don't begin to change some of those strategies, even if you do have some generated income, you've still got to sell those shares.
Right.
Because your mutual fund company doesn't, that's not how it works. When they got to sell shares and sell stock if you turn around and reinvested everything.
Exactly. So I think that brings up the other debate where some folks are very comfortable in the markets, or they have been historically. They were comfortable riding that roller coaster when they were younger, right? Now time may not be on their side and they're wondering, do I even still need the stock market? Is it an all or nothing? How do you help folks navigate what they're comfortable with?
We're real big believers in balance and trying to find a balance for each person because everybody's situation is a little bit different. We still believe you need the market for upside potential long term. You
to keep up with inflation,
to
for
keep
example,
up with inflation.
Right? Yep.
So, but you need to find the balance that's right for you, and that's going to be different. It's going to be based on a lot of different factors, including Social Security benefits and whether they have pensions and where are your assets allocated right now, because depending on where they're allocated determines what your income taxes are going to be based on your income planning and taking out things in the most efficient manner possible. So there's a lot of different factors that come into play.
Well, and Mark just brought up another topic about taxes. Market adjustments can be great opportunities to tax harvest and reallocate non-qualified assets, which I had somebody come in just the other day and they're already in that position. And I'm asking if your current advisor, and they're like, we've never broached that topic. And the reality is that they were trying to make a switch from, in their non-qualified aspect from a mutual fund to a more equity ETF position anyway, because they understand that, mutual funds aren't always the most efficient vehicle to keep in my non-qualified when we're talking about taxes.
Right.
Not picking on mutual funds, they're great in an IRA, but not non-qualified. This is a great opportunity to be able to take advantage of some strategies that maybe 3 months ago we thought we'd never have that chance.
Or do a Roth conversion at this time.
Yes.
Great.
Yep.
Let's get all that growth back in an account that will never pay taxes on.
I want to ask you guys more about that. I know we have to wrap up this segment, but clearly you've made a strong case for there's so much more that goes into this conversation. So if somebody's watching and going, I hadn't even thought about this, or taking advantage of this market volatility at this point in time, what would you say to them?
Man, I'd just say, hey, if you're out there right now and you're fearful, you're concerned, you don't know how to best take advantage of reality that's been presented to you, reach out, give us a call the number, scan the code over on the other side, come in, visit with us, let us assess your situation, see where you are today, help draw up a plan to get you where you want to go. We can help, again, hopefully make some lemonade out of some lemons.
Yeah, for sure. I think that sounds like a beautiful opportunity to take advantage of what we're dealing with right now. So if this is resonating with you, or if you're already working with another financial advisor and they're not having these kinds of conversations with you, it might be time for you to get a second opinion, and the team of Retire Path Wealth would love to provide that for you for no cost, no charge, and no obligation. But you have to reach out, and you can do so by calling 866-724-3893 or scanning that QR code that you see there in the bottom right-hand corner of your screen. We're going to continue this important conversation around market volatility and your retirement date right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back. You're watching Arkansas Money Talk, where today we are having the important conversation about market volatility and your retirement date. We know that a lot of you watching might be fearful based on what the stock market is or is not doing. Reality is none of us can control it, but we have to be prepared to navigate no matter what the markets might be doing, especially when it comes to protecting your hard-earned wealth to last you throughout the rest of your life. There's something that I think it's important to always educate and talk about when we're talking about market volatility, that is something known as the sequence of returns risk. Would you mind defining that for our viewers and helping them understand how that ties into what we're talking about and how they can be prepared to handle that?
Yeah, sure, Kristen. It's something that, and we talk about it a lot in the workshops that we do. We talk about sequence of returns. Most people don't understand what it is. And it really just comes down to, it depends greatly on what your returns on early on in your retirement to how well your retirement assets actually perform and whether or not you're going to run out of money. So if we have early years of losses as we're taking out money, we're far more likely to run out towards the end of our retirement than if we had higher returns in the earlier years and then had losses further into our retirement.
Right, and that's the problem, is we can't control what it's
We
going to do.
have no control
right?
over that.
Yeah, yeah. So what is the strategy? How do you help folks be prepared for the sequence of returns risk?
The basic first step is understanding what you need for income. And that this, again, is a conversation. Retirement income planning, folks, is about income. It's not necessarily about asset allocation. It's about generating and keeping consistent cash flow in place. So the reality of it is we need some assets positioned in a place that are not going to fluctuate negatively if markets do that. So we have a place that, let's call it a buffer, let's call it a volatility zone,
place to
something
shelter,
else.
right?
Yeah,
Yep.
whatever word brings confidence to your situation, to know that I have a place to be able to generate that income from where I'm not negatively affecting my long-term outcome. That way, then I have the ability to begin to allow those other assets to grow back, to generate. Also, maybe those assets are generating income while they fluctuate. Folks, the reality is if I'm generating dividends from my portfolio and the markets decline, I'm still generating the same amount of income. That market calculation doesn't typically affect dividend calculations whatsoever. If I've got cash sitting over somewhere where I can replace that and buy more, I'm adding to my dividend flow as time moves forward. So it's such a challenge to figure up hey, what's this perfect allocation that's out there? Because it's different from everybody.
Yes.
But once we know what the need for income is, we can definitely hone in on that, get you a situation where we can get a written income plan put together for you specifically. So if you don't have something that you have the ability to go back and reference when markets are difficult, that I have that shield that I can jump back into when I don't really understand what's going on, please reach out, come in, visit with us. Let's get something targeted specifically to your situation.
Dale, Mark, thank you so much. And thank you to our viewers for watching. We encourage you to reach out, and we look forward to being back with you next time here on Arkansas Money Talk.